For most of the last half-century, Germany has been Europe's economic engine, efficient, disciplined, and unstoppable. The nation that once built cars for the world, powered Europe's factories, and stood as the model of stability. But today, that reputation is cracking. The German miracle that kept Europe steady through crisis after crisis now faces its own reckoning. Factories are closing, exports are shrinking, and the country has slipped into recession. Again. In response, Berlin has done something unthinkable. It's throwing away decades of fiscal caution and betting 500 billion euros, the largest spending package in modern German history, on one last attempt to restart growth. If it works, it could save not only Germany but the entire European economy. If it fails, it might take Europe down with it. Germany's rise after World War II was nothing short of miraculous. By the 1980s and 1990s, it had become the industrial core of Europe, building the cars, machines, and tools that everyone else depended on. While other developed nations shifted towards service industries and financial markets, Germany stuck with manufacturing. That model worked brilliantly for decades. German cars, chemicals, and machinery were the gold standard across the world. Exports fueled half of its GDP, 3 times more than the United States, and trade surpluses kept government finances in perfect shape. Berlin didn't need to borrow much, and debt remained among the lowest in the developed world. In short, Germany became rich by selling precision-engineered goods abroad, and it seemed like nothing could shake that formula. But that same model also created a silent weakness: dependence on foreign demand and cheap imported energy. Then came 2020. The pandemic shut down global trade almost overnight. For a country that sells nearly half its output abroad, it was like pulling the plug from the wall. Exports collapsed, factories slowed, and car production fell to levels not seen since the financial crisis. By the end of that year, Germany's economy had shrunk by nearly 5%, its worst performance since the war. Just as things began to recover, another blow hit: Russia's invasion of Ukraine. Germany had built its entire energy system around cheap Russian gas. Before the war, over half its gas imports came from Moscow, feeding its steel plants, chemical giants, and car factories. When that supply disappeared almost overnight, electricity prices skyrocketed, and many factories could no longer afford to operate. What followed wasn't just an energy crisis. It was an identity crisis for a nation that had always seen efficiency as its greatest strength. Most governments would respond to a crisis like this by spending big, pumping money into the economy, protecting jobs, and funding recovery programs. But Germany had tied its own hands. In 2009, the country passed the so-called debt brake, a constitutional rule limiting how much the government could borrow each year. It was a proud symbol of German discipline, but also a trap. When unemployment passed 3 million and factories stood idle, Berlin's hands were still tied. The government couldn't spend what it needed to keep the economy afloat. For a country that had always prided itself on caution, that rule became a straitjacket. And so by 2025, Germany found itself in something few thought possible: a second consecutive year of recession with no clear way out. Then in March 2025, came the announcement that changed everything. Chancellor Scholz's government decided to suspend the debt brake and launch a 500 billion euro investment plan, roughly 15% of the nation's entire GDP. For Germany, this wasn't just economic policy. It was a philosophical shift, abandoning decades of fiscal restraint in favor of a massive state-led spending spree. The package would fund infrastructure upgrades, green energy projects, and support for struggling industries, a once-in-a-generation gamble to reinvent the German economy from the ground up. The question is, can €500 billion really fix what's broken? The plan is divided into 2 main parts. The first, roughly €300 billion, is aimed at modernizing infrastructure. Germany's highways, railways, and digital networks have fallen behind. Despite its reputation for efficiency, a third of major bridges are in urgent need of repair, and large parts of the country still lack reliable broadband. The government hopes that new high-speed rail links and logistics corridors will connect its major cities and factories more efficiently, cutting transport times and costs and making its exports competitive again. The second part, about 100 billion euros, flows into what Berlin calls the Climate and Transformation Fund. That money will finance offshore wind farms in the North Sea, new solar capacity, and clean energy technologies designed to end Germany's dependence on foreign fuel once and for all. If it works, these projects could generate clean power for millions of homes and help bring down energy prices that have crippled its industrial base since 2022. But this isn't just about Germany. The entire European Union depends on German stability. When Italy, Spain, or Greece run into financial trouble, it's usually German credit and guarantees that keep them afloat. Investors buy European bonds because they trust that Berlin, the most disciplined player, stands behind them. If that trust begins to fade, the consequences could ripple across the continent. Credit rating agencies have already warned of possible downgrades, and some investors are quietly trimming their German bond holdings. In other words, Germany's bet isn't just about its own economy, it's about the credibility of the whole European project. There's another challenge: timing. Infrastructure and energy projects take years to complete. Yet Germany's economic pain is happening now. The Bundesbank estimates these investments won't significantly boost growth until 2027. But interest payments on new debt start immediately. Berlin will need to pay around 40 billion euros a year just to service the debt, roughly what the country spends on education. If bond yields keep climbing, those payments could soar even higher. So while the plan might look brilliant on paper, delays or cost overruns could turn it from a recovery program into a financial nightmare. History gives mixed signals. After World War II, Japan rebuilt its economy by investing heavily in infrastructure and manufacturing, achieving decades of near double-digit growth. But Germany's situation is different. It's already a developed, aging economy with high wages, expensive energy, and a shrinking workforce. Rebuilding bridges and adding wind farms won't transform it overnight. Still, there's reason for cautious optimism. Few countries are as organized, innovative, and export-driven as Germany. If any developed nation can engineer a turnaround through planning and persistence, it's them. This 500 billion euro gamble could mark the birth of a greener, more resilient economy, or it could be the moment Europe's strongest link finally gives way. Either way, what happens in Germany over the next decade won't stay in Germany. It will shape the future of Europe's economy, and maybe redefine what it means to bet everything on a miracle. So what do you think? Is Germany making a bold, necessary move, or has it just crossed a line it can't afford to? Let me know in the comments below. If you found this breakdown useful, give it a like, subscribe for more deep dives into global economics, and ring the bell so you don't miss what's next. Thanks for watching, and as always, stay curious.